Imagine closing Wednesday with 3 winning trades in a row. You start doing mental math on your year-end profits. But by Friday afternoon, you're staring at a red screen, your account drained. What you experienced earlier in the week was a random streak of luck. In the professional world, a streak is a temporary anomaly. A strategy requires hard rules. Beginners routinely chase an impossible standard, the 90% win rate. They buy signal services and swap indicators, trying to eliminate losing trades entirely. A high win rate often conceals a negative expectancy profile. You might accumulate 9 small, steady wins, but if you trade with tight profit targets and no stop loss, one massive loss inevitably wipes out the entire balance. If you cannot define your mechanical advantage in a single mathematical sentence, backed by hard data, you aren't trading. You are simply gambling with better financial vocabulary. Long-term profitability relies heavily on how you handle your losing trades. A sustainable account grows because of how it manages mathematical failure, not because it avoids it. This equation right here is the only baseline that matters: positive expectancy. It calculates the average amount of capital you extract per trade over a large sample size. Let's plug in the numbers. Assume you have a system that wins 40% of the time, and your average winning trade nets you $600. Now for the other side. You lose 60% of the time, meaning the vast majority of your trades fail, and your average loss costs you $200. Do the math. 240 minus 120 leaves you with a positive expectancy of $120. Your system generates that exact amount in positive cash flow every single time you click buy or sell. The driving force inside this equation is the R multiple. That is the strict mathematical ratio of your reward relative to the risk you take. Compare an amateur who wins 80% of the time but risks $10 to make 1, against a professional who wins just 30% of the time but catches moves that pay out 5 to 1. The professional builds a highly lucrative business out of those 5 to 1 payouts, while the amateur's 80% win rate guarantees a broken account over a long enough timeline. Securing a positive expectancy removes the emotion from the desk. You stop hoping the market moves your way, and you start running a cold, predictable data extraction machine. But how do you find the precise variables to plug into that formula? Global markets are highly efficient, meaning you have to hunt for specific cracks in the system. Professionals do this by constructing a multi-layered advantage built on 3 distinct pillars: structural, analytical, and psychological. Take the structural pillar. On this simplified candlestick chart, you see an institutional liquidity hunt. Retail traders place obvious stop losses right under a recent low. Institutional money drives the price down to sweep those orders, utilizing that burst of liquidity to fill their massive positions before reversing the trend. The analytical pillar adds a layer of timing and repetition. You might recognize that an asset moves predictably during the first 90 minutes of the New York session, allowing you to specialize in that isolated window of volatility. The psychological pillar holds it all together. This is not positive thinking. It is the quantifiable discipline to sit on your hands and protect your capital when your setup is completely absent. To prove these variables actually work together, you apply the rule of 100. Any edge must maintain its positive expectancy across a forward-tested sample size of at least 100 trades to filter out random market noise. A true trading edge is never a secret indicator. It is a meticulously documented set of rules proven to exploit a specific market inefficiency over a statistically significant sample size. Once the math proves your edge exists, your entire psychological framework shifts. You adopt the casino mindset. Casinos never panic when a gambler wins a jackpot. They know their probabilities are locked in, and over 100,000 hands, the math guarantees the house extracts its profit. However, you still have to watch out for edge decay. Notice how this equity line suddenly degrades. A strategy that dominates in a high interest rate environment can quickly expire when global market regimes shifts. To survive that decay, you must obsessively monitor your maximum drawdowns. If your losses cross your historical threshold, you immediately halt the strategy to protect your capital. Building a quantitative advantage means you stop guessing market direction and start auditing your math. Use the FXNX performance dashboard to upload your trade data and calculate your